Hey, dear students, this is Mustafa Mirchawala, your FR trainer. And today we are going to do March-June 23 latest past paper of F7 FR for ratio analysis, right? This is March, June 23, okay? And now what's my objective right now? My objective is to discuss this question. I'll discuss this question and I'll solve the practical part. But for the theoretical part, I'll explain you, and then you will have to send me. You will have to write it and you have to send me for marking. As you guys know, we provide marking facility. So you must avail this facility if you want to improve, right? Okay. And this is the latest past paper. If you can do such, if you can understand this thing, if you can do this, so the paper is nothing for you, right? Okay, so let's start. Let's don't waste the time. Now, the scenario relates to three requirements. There are three requirements in this question. First two requirements are honestly a piece of cake. V-Room is an established company in an automotive industry and has been selling cars globally for many years. This is their business model. On 1st of January X3, see this date and these date. This is December X3. See, this is December X3. So your accounting period is, listen to me, your accounting period is 1st of January X3 to 31st of December X3. This is your accounting period. This is your accounting period. And you guys, they are saying you took over on 1st January X3. You took over on 1st of January X3, 1st January X3, right? That means on the first day of accounting period, parent company, which is V-Room, they took over a subsidiary company named Sleek. So parent is V company and subsidiary is S company. Very simple. V-Room company acquired 80% of Sleek company's 100 million share capital. This is first information. That means subsidiary company has issued. That means subsidiary company has issued total 100 million shares. Subsidiary company has issued total 100 million shares. And the total ordinary share capital, don't forget this, the total ordinary share capital of S company is 100 million. This will be used for goodwill purpose, right? Total ordinary share capital for S company is 100 million, right? So in simple words, out of this 100 million shares, parent company bought 80%, that is 80 million shares. Now, what is the price parent company paid? Consideration. Read it. This is our consolidation. Sleek company is a company which specializes in electrical vehicles. Yes, this is very super hit nowadays. V-Room company paid cash of 650 million. This is cash consideration on 1st January X3 and will pay a further $300 million cash on 1st January X6, like after 3 years. If Sleek company meets certain performance target. Now, this is what we call contingent consideration. This is what we call contingent consideration. Like, we'll pay the cash if this happens, if that happens, if this thing happens, then we'll only pay. So this is what we call contingent consideration. And IFRS 3 says, clearly listen, IFRS 3 says contingent consideration must always be recorded at fair value. Contingent consideration must always be recorded at fair value of acquisition. See, they will give you. Now, at 1st January X3, that is the acquisition date, the fair value of 300 million consideration due to be paid on 1st January X6 is 210 million. This is the fair value. And at 31st December X3, the fair value has been changed to 160 million. Now listen very carefully. Fair value at this date, fair value of contingent consideration is 210 million here. And here it is, the fair value is 260. Now, sorry, 160. Now, hope you remember, for the goodwill purpose, for the goodwill calculation purpose, acquisition date fair value will be used. And you know what is the entry? Let me show you the entry. The entry will be investment debit, which is 210, and contingent consideration credit, which is your liability credit 210. investment debit and contingent consideration credit. Investment debit and contingent consideration credit. Okay. Now, two things will be used as a COI in this question. Two things will be used as a COI, cost of investment in this question, as a cost of investment in this question, right? One is cash consideration. My respected students, see the screen, that is 650 million. Cash consideration is 650 million, and contingent consideration must always be recorded at fair value of acquisition, which is 210 million, which is 210 million, which is 210 million. Okay, so these two will be recorded in the calculation of goodwill. These are your COIs, right? Now, one more thing, very interesting thing, and I'm sure those who have taken proper classes, they know this concept. Listen, the fair value of contingent consideration at the date of acquisition is 210, but later on it converted into 160. It converted into 160. So your contingent consideration is your liability. Contingent consideration is your liability. See, the fair value of liability goes down. So you know the rules. Any liability that has been vanished without paying anything. Any liability that has been vanished without paying anything is your income. Any liability that has been vanished without paying anything is your income. Or I say this in Hindi, Urdu language, because I have Urdu staff, Urdu students as well. कोई भी liability बगैर कुछ पे किए खत्म हो जाए तो वो हमारी income होती है. Remember? Okay. So now what we'll make the entry? We'll make the entry like this. Contingent consideration debit. See, you will debit your liability. Contingent consideration debit. 210 to this is 50, and you can credit P&L, parent company P&L, or ultimately when you credit parent company's P&L, your consolidated reserve or retained earning will go up. This second entry is not needed in this question, just we'll discuss in theory. Yes, in the comment section, this should be discussed. This should be discussed, but they didn't ask this second entry, okay? Even they didn't ask the first entry. I have made the first entry just for your knowledge. So do remember, if the accountant has prepared correct consolidated accounts, see, the consolidated accounts are here. Consolidated accounts are here. Last year it's single company, and this year is consolidated accounts. Why? Because now parent and subsidiary both are there. So my dear students, if they have prepared correct consolidated accounts, so this 50 income is also there. This 50 income is also included here. This 50 income has already been included here if the consolidated accounts are correct. If the consolidated accounts are correct, and yes, they are correct. Yes, they are correct. Okay. So till now, I have calculated you both COI. The COI is cash consideration is 650, and contingent consideration is 210 at the rate of acquisition. Now, be active, do not sleep, just look at the screen carefully. Sleek company is VROOM's only subsidiary. That means parent company has no other subsidiaries. Extracts from VROOM's group consolidated statement of profit and loss for the year ended 31st December X3 and VROOM's statement of profit and loss for the year ended 31st December X2. Let me enlarge. See, last year, see the screen. Last year, you were given individual companies income statement. Last year, you were given individual companies income statement, and this year you have consolidated income statement. Last year, you were given individual companies income statement, and this year you have consolidated income statement. So the first thing is, this income statement is parent plus subsidiary, and this is only parent. Okay, so just a general point, this comparison is not like with like. If you compare last year with this year, obviously here we have two companies. In 2003 we have two companies. In 2002 only one companies. One more thing I would like to highlight, be very careful and don't sleep. Last year when parent company was alone, there was only sales of 12,200. Okay, now with parent and subsidiary combined sales is 13450. Can anybody tell me how much is the increase? How much is the increase? This is 1250 million. 1250 million increase. So that's total sales revenue increase is 1250. But do remember, this 1250 increase also include the subsidiary element, because in 2003 it's P plus S. In 2003 it's P plus S. Okay, so it includes, my respected students, it includes P plus S, right? So we need to remove S element from this 1250 in order to check what is the real increase of P company. Okay, this I'll be doing. One more thing. Last year combined a single parent company's profit was 940, and this time combined profit from operation is 730. It means either parent, see it's going down, either parent or subsidiary is in very bad position. Either parent or subsidiary is in bad position. That's why the combined result has gone down. Even the expenses also increase. See this expenses has gone up. That means either parent or subsidiaries expenses are not in control. So it's not difficult. Be strong. It's all business. This topic is all about business. Be strong and think positive now. Now the next page. A member of finance team has correctly, see the word correctly, they are giving you correctly calculate the capital employed. Ready-made capital employed is given. That means you can easily calculate the ratios as well. The ratios are free marks here. Now add the date of acquisition, that is on 1st January X3. S company has retained losses of 80 million. There is no retained earning, it's loss. So can I make a packet of acquisition date net assets of S company? Remember this packet, acquisition date net assets of S company. If you have seen the last page, ordinary share capital was 100 million. Subsidiary company's ordinary share capital was 100 million. One thing. Second thing, you have a retained earning. Retained earning is negative here. They have already told you the retained earning is retained loss. Acquisition date is retained loss. Okay. So I'm making the acquisition date packet. As a student, you may ask, sir, why are you making this acquisition date net asset packet? Because I have to calculate goodwill, and we compute goodwill at acquisition date. So the next thing is sleek company. You remember the fair value adjustment, and we have done in the class different types of fair value adjustment. See, it's a different one. Sleek company has also had unrecognized intangible assets estimated to have fair value of 250 million and a useful life of 10 years. Now, wait, hold. Hope you remember. Sometime it happens when parent company acquires S company. When parent company acquires S company has certain intangible assets which are not recognized in the S company books, like internally generated brands. For subsidiary company. For subsidiary company, those brands are internally generated and they should not be recognized in the individual books. But parent company has purchased S company. So for parent company, these are purchased brands. So in the consolidated books, these brands must be recognized. So you remember, we'll give birth to these assets. So hope you remember, C is equal to A minus L. Remember, it's like upward fair value adjustment. We'll increase the asset at one end. On the other hand, the net asset will go up. Remember, so it will be like upward fair value adjustment. Such intangible assets are like upward fair value adjustment. Intangible. So it will be 250 million. Okay. So I have calculated I have calculated the acquisition date net asset packet. I think it's 350 minus 80 is 270. Okay. Acquisition date net asset packet has been calculated. 350 minus 80, it's 270, right? But one more technical point, one more tech only for active students. When we have done fair value adjustment and the life is 10 years, see that it has a finite life. It has a finite life, so there will be excess depreciation. We need to depreciate it because why? Just think, S company has not yet recognized. S company has not yet recognized these intangible asset in the individual books. So in the individual books, there is no intangible asset as well as no depreciation. But for the consolidated books, this intangible asset must be there and we need to depreciate it as well. So 250, just wait, 250 divided by 10, there will be a 25 per annum. 25 per annum depreciation or amortization will be booked in consolidated books every year. That's why consolidated P&L profits are down. If you have seen, let me show you, open your eyes. See, in the consolidated books, see, last year it was individual books, this year in the consolidated books your profits are down. In the consolidated books your profits are down. Your profits are down. Okay, your profits are down. Okay, in the consolidated books your profits are down. So one of the reasons, see, this we have to discuss in commentary. One of the reason of the decrease in profits in the consolidated books is this excess depreciation, okay, of fair value adjustment. One more thing, my dear respected students. See, they will ask you goodwill, so they will give you fair value of NCI, because in full goodwill method, and we must have fair value of NCI. In full goodwill method, we must have fair value of NCI. So the non-controlling interest is measured at fair value, and the share price of Sleek company at acquisition date was 6.8. Yes. For fair value of NCI, we sometime they give you S company share price. Now go very simple, very simple. Listen, this is parent company, this is S company, and this is NCI. Just wait. S company has issued total 100 million shares. S company has issued total 100 million shares. Go very simple. Out of which 80% is bought by parent company. So 20% is with NCI. So 100 million is the total shares. 100 million multiplied by 20% is 20 million shares. Okay. So I would say NCI means just 20 million shares. I would say NCI means just 20 million shares of S company. Okay. So if you want to calculate fair value of NCI, just simply calculate the fair value of these 20 million shares. So what is the share price of one share? Share price of one share, it's 6.8. So you will multiply it by 20, multiply by 6.8. This will be your fair value of NCI. This will be your fair value of NCI. This will be your fair value of NCI, my dear students. Okay. So we have calculated COI, yes. We have calculated acquisition date, net asset packet, see in front of you. We have calculated fair value of NCI, everything. So within seconds, we are going to grab 4 marks, 4 easy marks, right? So see the requirement number 1. See the requirement number 1 now. Calculate the goodwill that arose on the acquisition. Very simple. We have to calculate goodwill. Let me help you with this. Very simple. In simple terms, we can do it. You have COI. Number 1 thing is cash consideration. As I'm using iPad, so I'm doing with pen. It's a very small working, right? So don't worry about it. Cash consideration was, I think, 260. It was 260, 650, sorry. Then contingent consideration. The fair value of contingent consideration was 210. Okay, so this is totally your COI. Then fair value of NCI at acquisition. You have 20 million shares of NCI. NCI has 20 million shares of S company. Multiply by 1 share will cost you 6.8. So 20 multiplied by 6.8. Let me check. $136. Okay. 996. Okay. Less fair value of net assets of S company. So acquisition date packet, we have already calculated 270. I have already calculated with you. 726 is your goodwill. 726 is your goodwill. You got 4 marks. That's it. If you cannot score these 4 marks in the exam, you have no right to sit in the exam. This is total basics. Total basics. Even exam kit of consolidation is very difficult, far difficult, extreme difficult than this. Okay, next thing. Next thing is what super easy thing, super easy, but I would request you to read the first let's read the next 3 points, 2, 3, 4, and 5. Okay, 2, 3, 4, and 5, and then we'll do the practical plus theory together. Sleek company has been correctly accounted for in the consolidated financial statement. That means, yes, all the excess depreciation, everything is recorded perfectly in the consolidated financial statement is perfect according to the consolidation rules. Their accountant is perfect, right? For the year ended 31st December X3, Sleek company's individual financial statement for the period showed revenue very good, 380, with losses from operations 170. That means the real problem is in S company. S company is in loss. That's why when parent company was combined with S company, the overall results of the group is down. So see, S company is culprit. One more thing. Listen. S company's individual sales revenue is 380. This year, S company's individual's income statement revenue is 380. Now, wait, be active. See this. There is a total increase. See the screen. There is a total increase of 1250. There is a total increase of 1250 in the sales revenue. Out of this 1250, just 380 belongs to S company. Just 380 belongs to S company. So the major, wait, 1250 minus 380. 1250 minus 380. 870 belongs to P company. That means P company is a giant. The real increase in revenue, the number of 1250, the total increase is 1250. Out of this 1250, 380 belongs to S company. So that means 870 belongs to P company. 870 belongs to P company, right? Okay. So that means S company's performance is not good, parent company's performance is good. Okay. And similarly, see, this overall profit came down. This is the major reason is the S company's performance is not good because the S company's operating profit from operation is in negative loss. You can see in the individual books they have written in note number 2. So keep this thing in mind. Now, in the face of declining global sales, VRoom company recently undertook the decision to invest in Sleek company due to the new technology it made use of. Now, see, nowadays, this is a real life problem. ACCA normally gives you real life situations. Worldwide, now normal fuel cars like petrol, diesel cars, the sales will go down and ultimately people will shift to EV, electric vehicles, right? Okay, people will shift. So VRoom was doing the traditional production. So they decided to took over Sleek company for this technology shift. Particularly in research to the research it was undertaking regarding long battery lives and self-driving technology. Yes, now wait. Sleek company, subsidiary company is in the process of doing research. Subsidiary company is in the process of doing research for long battery lives and self-driving technology. Okay. So this is a long-term plan of B company to enter in this market. Now this is very important. During 2003, Sleek company continued. Sleek means subsidiary. Continue to invest in significant amounts in the battery and self-driving technology. Now there is a turning point. In January 2004 means next month after the end of our accounting period. Next month after the end of our accounting period, that means our accounting period has been passed. Listen, in January 2004, it was confirmed, IS 38, that the new battery technology was viable. See, development, research and development, IS 38. That means from January X4, it is confirmed. Now it is confirmed that this project will be beneficial for us. So before this, everything is research. Before January X4, that means our current year, all current year expenditure is research expense and it goes in P&L. Sleek company was able to patent this technology and the project entered into the development phase at this point. Yes. So from next year, that is January X4, our accounting period is 31st December X3. See, our accounting period is 31st of December X3. Our accounting period ended on 31st of December X3, 31st December X3, right? So this year, now the question, I'm giving you evidence. This is a real mark away, scoring mark. This is a scoring point. Why subsidiary companies is in loss this year? Why subsidiary company is in loss? See, they have told you the loss. Because subsidiary company is in the research and development thing. Subsidiary company is doing research for these long life batteries and self-driving technology. And right now in December X3, in this 2003 year, subsidiary company is in research phase. And when you are in research phase, whatever expenditure you do is expense. Whatever expenditure you do is expense. Right? So this is one of the reasons. But listen, Don't blame as company that as company is bad. This is basically a sacrifice. You sacrifice today for future. Like what you guys, some students, they work in big four on low salaries, but in the long term they get the return for it. Same is the case. So right now in this year, subsidiary company is doing research, and because of this research, everything is going in P&L. So it is going to hit your income statement negatively. But for the long term, this is very good. But for the long term, this is, my dear student, very, very good. Okay. It is expected that this will be completed in early 2004. The self-driving technology is still in research phase. Okay. And this one more thing I can say, that parent company has promised. You remember the contingent consideration. One more technical point. You remember the contingent consideration. Parent company has promised to give subsidiary companies owners some extra payment of $300 million only if the performance targets are met. So according to this point number 4, it looks like subsidiary company will meet things in future, because subsidiary company is on the right track. Subsidiary company is going with the flow. Subsidiary company is going with the latest technology thing, right? What the real world demands. VRoom also, now VRoom, wait, VRoom is parent company. Now we'll give the reason why parent company is going good. See, subsidiary company apparently looks bad. Subsidiary company apparently looks bad according to the results and numbers, but parent company's results are good. I just proved through sales. Why? VRoom company has launched a range of after sales service arrangement for new customers during 2003. Due to lower repairs required on new vehicles, these have been profitable for VRoom. That means parent company is very good in profit, is in profit. Parent company is in profit, and parent company's margins are also good. When you are in good profits, that means you are in good margins. So if you see, listen to me individually. If you look VRoom, this is point number 5 is purely related to VRoom. If you look at VRooms, the parent company only, if you look at VRooms, the parent company only, so it says the only parent company data says that parent company is going good. Why? See, this point you have to write in the comment. Because parent company has launched after sales service, and as the quality of their good product is excellent, so there are very less repairs. So yes, they are making extra amount earning. They are making extra earnings because of after sales service. Obviously, they'll charge for it, but the cost is low because low repairs, due to lower repairs of new vehicles. Because normally new vehicles, normally they don't ditch you. They in the starting phase, they are good, right? So individually, parent company is in good profit, but yes, the group overall is not looking good because of S company. So giving you 1 minute to read it. Please have a look. Just read this point and think over it. So now we are moving toward another easy requirement of 3 marks. This is super easy requirement, just 3 ratios. See, they are asking you GP margin, operating margin, and this return. See, using using pre-formatted table provided. Obviously, now in the software, they will give you such tables and you have to calculate it. Calculate the following ratios for the year ended 31st December X3 and 31st December X2 for VROOM group. Yes, in December X3, it's the group data, but in December X2, only parent company. GP margin is what? GP margin is GP upon sales into 100. Okay, GP upon sales into 100. So here we have less space, so let me do it on a separate page. So you have, this is group, this is single. Okay, just ready-made data. GP margin, GP divided by sales times 100. Okay, so what is your GP? You can take the picture of the question if you want, so that you will have, because I have to move the screen. So what is the GP? What is the GP? The GP is 2300 divided by 13450. 2300 divided by 13450. And this will be 2200 divided by, let me check the question on another screen. You can also view it on the other screen. It's 2400, sorry. Divided by 122,200. Okay. So let me calculate the number. The number here is 17.1%. This is very, GP margin is very ready-made ratio. And this one is 19.7. See, your GP margin is going down from 2002 to 2003. It's going down. But it was written that parent company has successfully launched the after sales service, and that after sales service is extremely profitable, so the margin should go up. In reality, because of the parent company's good performance, the margin should go up, but they are going down. That means there are some other reasons. Not that product is good, parent company's after sales product is excellent, but because the margin is going down, there are some other reasons of S company's cost. Then we have operating profit margin. So this will be PBIT, or operating profit, divided by sales into 100. So what is your PBIT this year? It's 730. Group's PBIT divided by sales is 13450 times 100. It makes 5.4%. Okay. And here you have 940 is the PBIT divided by, this is a very ready things. This is ready, just readily picking up the data from the question, nothing else, to be very honest. Okay. So again, your operating margin is going down. Finally, you have ROCE, return on capital employed. So the formula is PBIT divided by capital employed times 100. So PBIT is again 730. Now wait, where is capital employed? See, it is given ready-made in the question. This is the capital employed. Students, look at the screen. See, these are the ready-made capital employed for you guys. And yes, the capital employed is increasing. So to be very honest, I didn't do any adjustments in ratios working. Yes, in many past papers, in many exam kit question, you sometimes have to adjust things as well. But in this question, no adjustment, just copy paste figures from the question. That's it. So here the rows is, here the rows is 2.2%. Okay, and here the rows is 3.0%. So again, the return on capital employed is also going down. Return on capital employed is also going down. Return on capital employed is also going down. Okay, so this is requirement number B. These 3 marks are also free marks, and these 4 marks are also free marks. So if you can't score these 7 marks, then it is okay, you got failed. Then you deserve failure. Then you deserve failure, and your data should be disclosed on Facebook and LinkedIn everywhere. There should be a separate video on you. If you can't score these 7 marks, that means you know nothing. To be very honest, you know nothing, 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 nothing. See, the calculation of ratios is like F3 level. It's basic A levels type thing. This calculation of goodwill is basic level thing. It's not advanced. Calculation of goodwill is not an advanced thing. So now we are moving towards the requirement C, and I'm going to see first C. Analyze the performance of Virum Group for the year ended 31st December X3 compared to the performance of Virum for the company's 31st. That means we have to compare these 2 years. It's 13 marks. Always remember that in theory, you can score up to a maximum certain level, not 100% marks normally. So it's routine, and you don't need to waste much time in this, okay? Because you have already scored 7 easy marks in this question. So now I'll give you some points, and you have to solve this question again. You have to solve the theory part or complete question again, and you need to send me on that email ID, examination scripts. You have that email ID, right? And then I'll mark it, please. In this way, you will be able to write it. You will be able to know your mistakes, what mistakes you're doing. So first thing is you can write on the revenue increase. First of all, comparison not like with like, just this. Last year there was only one single parent company, now P plus S. So these books are generally not comparable, but still we'll discuss. Number 2, there is a revenue increase. There is a revenue increase of 1250 million. Remember, we just compared 1250 million. So in the beginning, we said that 1250 million increase in revenue from last year to this year. Maybe this also include S company. This also include S company. That's why 1250 million increase, right? I repeat, in 2000 X2 there was only parent company, but now this year it's P plus S. So if the revenue is going up, so there is a contribution of S company as well. Now in the third point, you will tell that out of this 1250, only 3, how much? Wait, only 380 million. Yes, only 380 million belongs to S company, because in note number 2 or 3 they have told us, and the remaining 870 million was because of P company. Okay, so that means S company's performance not good, performance not outclass, but yes, P company's performance is good. Okay, now why the P company's sales is better? Why the P company's sales is better? because of new after sales service. They have launched new services after sales service, right? And that's going very good. That's going very, very good. Okay. One more thing you can highlight, extra point. I'm telling you, it's your wish if you want to include that. See, parent company is still in the traditional business of cars like petrol or diesel cars, and S company is in electrical vehicles. So there is a voice in the world that electrical vehicles is the future and there is no future of normal cars. But see, still the normal cars, parent companies in normal cars, and still the sales is good. So it looks like just a discussion. It looks like that this is just a voice. This is just a voice. Even I tell you my practical example. I normally spend a lot of time in Texas. So Texas is the hub of oil and gas. Texas is the hub of oil and gas. So in Texas, whenever I meet Texas people, what's their mentality? They like the voice of car. They like the voice of sports car and all. And voice means the petrol or diesel car. They don't prefer electrical vehicles. So it also depends on the taste of the public as well, right? Okay. So it is okay. It is good. It is acceptable that in future majority cars will be electrical cars. Electrical cars are good for planet. It's environmental friendly. It's cost effective. If the fuel prices are high, then electrical vehicles are cost effective. Everything is good. But yes, there is a taste of people as well. Some people like the sound of the engine, right? Getting. So we can also at this point that parent company's sales is good. That means people still want the existing old school cars. Then number fifth, you can write upon the margin. GP margin. Can you see GP margin went down from 19.7 to 17.1. Okay. So the GP margin is going down, although it is written that parent company is in high profits, parent company's product is going profitable. Then why GP margin is going down? So that means problem is, I think, means problem in S company, because now in the second year we are using combined problem in S company or other factors. S company or other factors. Okay. I'm just giving you hints. You have to write it yourself. Now you guys are no more kids. Many questions we have done in our learning management system. It's time for you to solve the question and send me. Okay. Otherwise, you won't be able to perform in exams. Then number 6 point. It is written clearly that S companies in the whole 2003, S company was in research phase. S company was in research phase for both battery lives and the self-driving cars technology, right? In 2003, S company was in research phase, and research is expense. Now, when the research is expense, that's why S company's expenses are extremely high. S company's expenses are extremely high, and that's why S company is in loss. Point number 2 or 3, it is written. See, in the point number 2 or 3, it is written. You can see S company is in loss with losses. See this. So this is one of the reason. This is one of the reason. This is one, research is expense. That's why. And one more thing I would like to highlight. Still, they have said in point number 4, look at me. Still, they have openly said in point number 4, what? That for self-driving cars, they are still in research phase. For self-driving cars, they are still in research phase. So get ready for 2004 expense. Get ready for 2000 X4 expense. There will be more expenses in 2000 X4 for that product as well. That the product name is, I think, self-driving cars. Okay. So you can expect more expenses in this year. This you can also write. Then for consolidated books, why the consolidated books performance went down? For consolidated books, we did one fair value adjustment. We did FVA for intangibles, remember? And with, I've already taught you this in the, for intangibles of 250 million. So 250 divided by 10, 25 is the extra depreciation. Excess depreciation is 25. So this excess depreciation must be the part of consolidated income statement, and that's why the consolidated income statement expenses are high and profits are down. So one of the reason of down performance, low performance in 2003 in the consolidated books is the excess depreciation, extra depreciation for this fair value adjustment intangibles, right? Now, 8th point is a good one. 8th point is a good one. Which one? You remember one thing I taught you, that contingent consideration must always be recorded at fair value at acquisition date, but later on the fair value changed. The fair value changed from 210 to was changed from 210 to 160. So remember, we made this entry contingent consideration debit 50 and P&L credit 50. This year this entry was made. I have already taught you in the beginning of this question. So you know, this is an income. This is income. Any liability which is vanished without paying anything is called your income. So this income is already part of your consolidated income statement. Still the margins are down. With the inclusion of this income, still the margin is down. Just think, if this income wouldn't be there, if this income wouldn't be there, there will be more bloods on the street. There will be more blood on the street. Think over it. So this income saved us. This is the first area of contingent consideration. Now the second angle, second point. What is contingent consideration? Listen. Parent company promised S company that we'll only pay you big amount if S company performs good. We'll only pay you good amount if S company performs good. But see, the fair value of liability is going down. That means now S company is not performing good. That's why parent company is expecting to pay low now, not high. Just think. Initially, parent company was expecting the fair value of liability as a 210. Now the fair value of liability is just 160. It indicates that now there is less chances of good performance. Decrease in fair value of liability, use your brain. Decrease in fair value of this contingent consideration means now parent company is expecting that S company's performance is going down. So this is a negative sign also. But yes, in ratio analysis, I have already always taught you this thing. I always speak this thing in my class, that you don't have directors with you. You don't have the director sitting with you. So you just have to use maybe, and different guesses you have to write. So one thing you can write in the question, it is written that parent company is on development stage now, that the projects are viable now. For S company. You can read the question. You have the question. You have the viable now for S company. So that means the future looks good. The future looks good. So you know what do you mean by the future looks good? If the future of S company is bright, think over it. If the future of S company is bright, that means next year this fair value will go up. This fair value may go to 250. This fair value may go to 250 if the future of S company is good. If the future of S company is bright, that means next year you may expect increase in the fair value, which is your expense. So more expense next year. Think over it. These are extra points. If you don't want to write, you can skip. These are technical points. Even during the lecture, even I didn't discuss. When I walked through the question, I didn't tell you these points. These are extra points. One more thing, one routine point which 90% time I discuss in my class, and it's also in the past paper. You know, your operating margins are also going down. Your operating margins in this question are also down. See, it's 7.7% and then 5.4. It's 7.7% and then 5.4%. So now the reason why our operating margins are going down, because GP margin is going down, the carrot forward effect. Remember, when your GP goes down, NP operating profit follows. So routine, why operating margin going down? Because GP also went down. This point you can also write. This point you can also write. So now, and you can always connect this operating profit margin. Operating profit margin has direct connection with operating expenses, the difference between GP and PBIT. So these are the points. This contingent consideration movement is always connected to operating margin. Now, finally, ROS. Finally, ROS. ROS is basically the formula is PBIT divided by capital employed. Now, open your eyes. PBIT divided by capital employed. Your ROS also went down from 3% to 2.2. Why the ROS went down? Very simple. First of all, your numerator went down. Your PBIT operating profits are down. When PBIT will go down, your ROS will go down. When PBIT goes down, your ROS goes down. And second thing is your capital employed went up. If you compare last year capital employed with this current year, the capital employed went up. Now, why the capital employed went up? Why capital employed went up? Few reasons. One reason I taught you in a question named Gregory. Answer. Number one is inclusion of NCI. Inclusion of NCI. Do you know this thing? That NCI is the part of equity packet. NCI is the part of equity packet in the consolidated books. So now where, see in this capital employed, last year, listen, in 2002, see this, in 2002, parent company was alone. In 2002, parent company was alone. Now it's P plus S. This year in 2003 is P plus S. P plus S means consolidated books. And you know, in the consolidated books, don't ever forget this. In the consolidated books, whenever we talk about capital employed, what is capital employed? Capital employed is shareholder equity plus non-current liabilities plus loans, shareholder equity plus loans. So when you talk about the shareholder equity of group, NCI is always there. NCI is always there. So that means there is one extra NCI. There is one extra NCI in the denominator. So because of this, your denominator went up. Because of this, your denominator went up, and your ROS went down. Number two reason may be, listen, I agree. I totally agree. I not only agree, I totally agree that subsidiary company's equity packet is always cancelled out. In the consolidated books, subsidiary company equity packet is cancelled out. We know this from the basic, but the liabilities of subsidiaries are included. The liabilities of non-current liabilities of subsidiaries are always included. You know that. And yes, the non-current liabilities are part of capital employed. Non-current liabilities are part of capital employed. So there may be a reason that this capital employed is going up because of liabilities. This capital employed is going up because of liabilities, right? Even the third thing is contingent consideration. See, because of this takeover, parent company promised to existing owners of S company that we'll pay you some consideration, which is called contingent consideration. So because of this contingent consideration, my dear students, it's also a liability, and it's a long-term liability because we have to pay after 3 years. So this also increase your loan, and this is the reason of reduction in ROS. This is one of the reason of reduction in ROS. So you have to write all these things. And finally the conclusion. in the conclusion, you will write, listen, apparently subsidiary company looks bad because of the short-term view. If you see the short-term view, it is bad. But the parent companies plans are long-term, because in the future, in long-term, electrical vehicles are the king. Even the world's biggest companies like Tesla, they will rule the world, right? So electrical vehicles will play a very important role in future. That's why parent company is looking for future. This type of things you can write in the conclusion. Okay, I hope you understood it, and I would request all of you to try to solve. If you don't solve, you won't be able to perform in the exam. See, these are the last days. These are the last days. So please send me this on that email ID which I have provided you, to my registered students, examinationscripts@gmail.com. Okay, so take care and bye bye. Allah Hafiz.